There's a detail in the stories families tell about surviving the 1970s that almost never gets explained. The money was kept separate, not merely saved, separate, held apart from the household account in a form that required nobody's approval. It gets remembered as thrift, sometimes as something sadder, a private fund kept quiet in a difficult marriage. Either way, it gets told as a character story. She was careful. She was clever. She got by. A habit that widespread is usually an adaptation to a rule. And in 1974, a wife earning $5,000 a year handed every dollar of it to prices that rose about 11%. When that household applied for a mortgage, the lender counted $2,500. The same money in the same year, valued twice by two institutions, and only one of those valuations was buying groceries. That was not a loophole. It was how American lending worked, and it is what made a separate stack of cash the most rational thing a household could hold. This is what that rule was. What it cost the household budget in the worst inflation year of the post-war era, and the 8 weeks in the autumn of 1974 when Congress rewrote it. The ledger for that year starts here. In 1974, the median American family income was $12,840. That is the Census Bureau's own figure, published in Current Population Reports, Series P60, number 101. Against that, the Bureau of Labor Statistics measured consumer prices rising about 11% across the year. Measured December to December, the increase was 12.3%. Either way, by that same Bureau's series, it was the sharpest cost of living increase the United States had recorded since 1947. For a household, an 11% year is not an abstraction. It is a subtraction. Every line on the page costs more in December than it did in January, and the paycheck at the top of the page does not move on the same schedule. This channel has decoded that page before, line by line. The grocery line, where the Bureau's index for sugar and sweets ran from 36.7 in December of 1973 to 74.0 in December of 1974, slightly more than doubling inside a single year. The savings line, capped by federal regulation at 5.25% at a savings and loan while prices ran at 11. The pension line that was not on the page at all. But there was one defense available to an American household in 1974 that was more powerful than any economy it could practice in the kitchen. More powerful than canning, coupons, or the envelope system combined. A second income, and households were reaching for it. By 1974, 49% of all joint tax returns reporting salaries and wages had two earners on them, according to Internal Revenue Service statistics of income. Nearly half, and the wife's share of that money was climbing. Among those couples, the proportion where she earned half or more of the joint income edged up from 13% in 1969 to 14% in 1974 and reached 17% by 1979. That is the household's answer to 11% inflation. Put a second name on the income line. Which brings us back to the loan desk. When that household walked into a savings and loan and applied for a mortgage, the second income on the top of its ledger was frequently not counted as a whole number. It was discounted. How much of it counted was, quite literally, surveyed. The United States Commission on Civil Rights, in a June 1974 study of mortgage lending, titled Mortgage Money, Who Gets It?, published the results of a Federal Home Loan Bank Board survey of savings and loan associations. The lenders were asked what they would do with the income of a specific applicant. A wife, aged 25, with 2 school-age children, holding a full-time secretarial position. 25% of them would count none of her income at all. More than half would count 50% of her salary or less. Only 22% would count all of it. Be careful with that survey, because the board itself was. It covered 74 institutions out of roughly 5,000 under federal supervision, and the board considered the results inconclusive. It is a sounding, not a national rate. But the commission also recorded what the sounding was measuring, and that is the part with no ambiguity in it. A primary consideration in underwriting, the commission wrote, was the female wage earner's age, and it stated the reason directly. Age was treated as directly related to the probability of childbearing. A married woman in her 20s generally would not have more than 50% of her income counted. For a married woman in her late 30s, 75 to 100% of that same income would qualify. So the discount was not really a judgment about the job. It was a judgment about whether the household was likely to have a child. Now put a whole household on an actual application and watch where the money goes. Take a household with a husband earning $8,000 and a wife earning $5,000, $13,000 of household income, right at the American median, both earned in full, both taxed in full, both deposited in full, both spent in full on groceries that had risen 11% that year. The lender adds $8,000, then it adds half of $5,000, $2,500, $10,500. $2,500 of that family's actual annual earnings simply evaporated on the way from the paycheck to the loan application. Not taxed away, not spent. Discounted by underwriting convention at the exact moment the household was trying to convert its income into the largest asset it would ever own. So the household is running a defense against inflation that the credit system will only give it partial credit for. The second income counts fully against every rising price in the budget and counts at half when the household tries to borrow. That is the collision at the center of 1974, and it is why the credit line and the inflation line have to be read on the same page. It went further than the discount itself. Some lenders wanted assurance that the second income would continue. The instrument for that was known in the lending trade at the time, in its own words, as a baby letter, not a note from the applicant. A physician's statement attesting to sterility of the husband or the wife, or to their use of approved birth control methods. It was not a universal requirement, and that is exactly the point. Branch managers at 2 lending institutions told commission staff that they required a baby letter before they would credit all of a young wife's income. The commission also found that whether it was demanded at all depended entirely on the attitudes of individual loan officers. The practice reached the federal government's own loan programs. The same commission report quotes a Veterans Administration Information Bulletin, numbered 26-73-1, issued on the 2nd of February, 1973. The bulletin addressed medical statements offered as supporting evidence that a couple are unable to have children. If such a statement was voluntarily submitted by the veteran to the lender, the bulletin said, it could not very well be refused upon receipt. In fairness to the agency, the same document insisted that it was not then, and never had been, the policy of the Veterans Administration to request or demand such disclosures. Read those 2 sentences together, and you have the whole condition in miniature. Nobody was ordering it. Nothing was stopping it either. Consider what that means as a matter of household finance. A family's mortgage application could turn on a doctor's letter about whether that family was going to have a child. That was an underwriting input. None of this is inferred. It was documented at the time by the government on the record. On the 22nd and 23rd of May, 1972, the National Commission on Consumer Finance held hearings titled Availability of Credit to Women. Women's organizations had gathered letters from across the country describing what happened at the loan desk, and the commission put the question formally on the record. Its report summarized that testimony as follows. Single women had more difficulty obtaining credit than single men, and this appeared, on the testimony, to be more characteristic of mortgage credit than of consumer credit. Creditors generally required a woman, upon marriage, to reapply for credit in her husband's name. Women who were divorced or widowed had trouble reestablishing credit at all. And fourth, creditors were often unwilling to count the wife's income when a married couple applied for credit. Read that third finding as a ledger event rather than as an injustice, and it becomes something very specific. If the account had been carried in the husband's name, the payment history built by that household over 15 or 20 years, every mortgage payment made on time, every store account settled, accrued to the name on the account. If that name was removed by death or divorce, the person left holding the household budget could be, in the eyes of a creditor, brand new. 20 years of demonstrated repayment, 240 consecutive mortgage payments, every one of them made, and no file. In 1973, before the Congressional Joint Economic Committee, Congresswoman Martha Griffiths of Michigan stated the pattern in the plainest terms available. Single women applying for mortgages or personal loans were frequently required to produce a cosigner, even when their incomes were high enough to secure the loan. And most of the time, she said, married women's salaries were discounted by lending institutions. Go back to the Commission's fourth pattern for a moment, because that is the one this whole ledger turns on. Creditors were often unwilling to count the wife's income. Written down by a federal commission in 1972. 2 years before anything was done about it, the Consumer Finance Commissioners also recorded an experiment, and it is the cleanest evidence in the whole file. The St. Paul Department of Human Rights sent 2 people to 23 banks, a man and a woman, with virtually identical qualifications, each asking for a $600 loan to buy a used car. Same figure, same story, same paperwork. 11 of the 23 banks the woman visited required or preferred her husband's signature. 6 of the banks told the man he could borrow the money without his wife's signature at all. Same $600, same credit. 23 institutions, and the variable being tested was not the money. Now, the version of this you have probably heard is wrong, and the true version is worse for the household budget. It is often said that women could not get credit in the United States before 1974. That is not accurate, and repeating it obscures the narrower fact, which for a household budget was worse. There was no federal statute forbidding a woman from holding a bank account or a credit card. Many women held both. Some banks lent to single women without incident, and some loan officers were entirely reasonable. The Commission did not even recommend federal legislation at the time it reported. But look at where it aimed its recommendation instead. It aimed it at the states, because a good deal of the obstruction lived there. The Commission noted that most state rate ceiling statutes prohibited creditors from maintaining separate accounts for a husband and a wife at all, and that older property doctrines made lenders wary of a wife's signature standing on its own. The accurate statement is narrower and, for a household budget, worse. There was no rule requiring a creditor to be reasonable. Sex and marital status were permissible things for a creditor to weigh. Whether the second income on a ledger counted for all of itself, half of itself, or none of itself was, in 1974, a matter of the institution's discretion and the officer's judgment. A household could not know in advance which it would get, and it had no recourse when it got the worst one. That is the condition the separate stack was answering. If access to formal credit in your own name is discretionary, then cash you hold yourself is not a quaint habit. It is the only instrument in the household with no application process. It cannot be counted at half the way $5,000 of her earnings was. It does not disappear when a name is removed from an account. It is the household reserve that no underwriting convention can reach. That is why the story is so widespread that nearly every family has a version of it. It was a predictable response to a documented feature of American consumer credit, which brings us to the autumn of 1974. In 8 weeks that fall, Congress rewrote 3 separate lines of the American household ledger, and nobody at the time laid them side by side. On the 2nd of September, 1974, the Employee Retirement Income Security Act became law, and the retirement promise that had sat on an employer's books began its long migration onto the household's own balance sheet. On the 8th of October, President Gerald Ford stood before a joint session of Congress and called inflation our public enemy number one, launching a voluntary campaign whose most durable artifact was a lapel button reading WIN. And on the 28th of October, 1974, the same president signed the Equal Credit Opportunity Act, enacted as Title V of Public Law 93, 495. 3 laws, 8 weeks, 1 budget. The retirement line, the price level, and the credit line, all rewritten in a single American autumn in the worst inflation year since the war. The Equal Credit Opportunity Act made it unlawful for a creditor to discriminate against an applicant with respect to any aspect of a credit transaction on the basis of sex or marital status. The Federal Reserve Board wrote the implementing rules, known as Regulation B. The act took effect 1 year after signing on the 28th of October, 1975. Note that date carefully because it matters to the ledger. The signature in October of 1974 did not change a single loan application in 1974. The household that was discounted by half in March of that year stayed discounted. The rule arrived in practical terms a full year later, after another year of prices. And note what the statute did and did not do. It changed exactly one thing: which facts about an applicant a creditor was permitted to put into the decision. Not the rate, not the term. Income, obligations, and payment history stayed in. Sex and marital status came out. For the household ledger, that is a narrow change with a wide consequence. It means the second income on the top of the page counts as the number it actually is. $5,000 of earnings enters the mortgage calculation as $5,000. The household that added an earner to fight an 11% year could finally borrow against the whole of what it had actually earned. The Act's later history shows how much was still unfinished. Amendments signed in March of 1976 extended the prohibited bases to race, color, religion, national origin, age, and the receipt of income from public assistance, and those took effect a year later still, in March of 1977. The credit file problem took longer still, because a payment history recorded under one name does not reassemble itself by statute. It had to be rebuilt account by account, household by household. So what does the ledger look like when you close the book on 1974? The income line held a second earner in nearly half of American married couple households, and that earner was the single most effective thing the household did about inflation, more effective than every economy practiced in the kitchen combined. The credit line counted that earner at a fraction, by convention, at the discretion of whoever was across the desk. And the reserve line, the one that never appeared in any budget book, held the difference. The 28th of October, 1974, did not change the prices. Prices kept climbing. 1975 was another hard year, and 1979 and 1980 were harder. Nothing in the Equal Credit Opportunity Act bought a single household a cheaper gallon of milk. What changed was narrower than that and more permanent. A household's access to credit stopped depending on which of the two names at the top of the ledger had earned the money. The instrument outlived the constraint. A household reserve held outside any account, answerable to no application, is still the first thing a budget under pressure reaches for, and it still appears in no budget book. The generation that kept those separate envelopes is often described as having been more disciplined than the one that followed. Read the record, and a different explanation appears, and it is not about character at all. They were not simply more careful with money. For a long stretch of American history, the formal system was not obliged to count all of theirs. If you want to see the rest of this 'this 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 the pension line. They are on this channel, each one sourced the same way. Thank you for watching.